Dollar cost averaging. The strategy that beats 99% of investors. Here's what most investors get wrong. They wait for the perfect moment to invest. They're sitting on cash, watching the market, convinced they can time it perfectly. Meanwhile, regular people who invest the exact same amount every single month are building wealth that compounds into six figures while the waiters are still waiting. This is dollar cost averaging. And I'm going to show you exactly why this beats 99% of investors. Not because it's complicated, but because it's so simple that most people overlook it. Part 1. What dollar cost averaging actually is. Let me break this down because the name sounds fancy, but it's literally just this. You invest the same dollar amount at regular intervals, regardless of whether the market is up or down. That's it. That's the whole strategy. Let's say you decide to invest $500 every single month into an S&P 500 fund through your Roth IRA or a brokerage account like Fidelity or Robinhood. You're going to do this whether the market just crashed 50% or whether it just hit an all-time high. $500 every month. No exceptions. Here's why this matters so much. Most people do the opposite. They get excited when the market's up. They buy a bunch. Then the market crashes. They panic. And they sell everything. It's the worst possible rhythm for building wealth. Dollar cost averaging removes emotion from the equation entirely. You're not trying to buy the dip. You're not trying to time the top. You're just consistently investing, which automatically makes you buy more shares when prices are low and fewer shares when prices are high. Part 2. The math that changes everything. Let me show you real numbers because this is where dollar cost averaging becomes absolutely undeniable. Scenario 1. You have $10,000 right now and you invest it all at once into an S&P 500 fund on January 1st. Let's say the market drops 20% in the next 3 months. You're down $2,000 immediately. You're stressed. You're checking your phone every 15 minutes. Scenario 2. You take that same $10,000 and invest $1,000 per month for 10 months. Into the exact same S&P 500 fund. That same 20% crash happens in month 3. But here's what's different. You're buying more shares at the lower price. When the market recovers, and historically it always does, you own more shares than the person who invested everything up front. Let me give you actual numbers from real recent history. From January 2022 to December 2022. The S&P 500 dropped about 18%. Brutal year. Someone who invested a lump sum of $20,000 at the beginning of 2022 would have been down about $3,600 by mid-year. Terrifying. Someone who invested $2,000 every month throughout 2022. By the end of the year, when the market started recovering in 2023, they had bought thousands of shares at discounted prices. Today, their investment is worth significantly more. This is the superpower of dollar cost averaging. You're systematically buying the dips without even trying. Part 3. How to actually implement this. This is where it gets simple because you don't need anything fancy. First option. Your 401k. If your employer offers one, you're already dollar cost averaging. Money comes out every paycheck automatically. You're buying shares at different prices throughout the entire year. Your employer might even match contributions. This is literally free money combined with the best investment strategy most people never implement intentionally. Second option. A Roth IRA. You can contribute up to $6,900 this year. Set up automatic monthly deposits of about $575. Use a fund like VU or VTI. These track the S&P 500 or the entire US stock market. Set it and forget it. Third option. A regular brokerage account through Fidelity or Robinhood. Same exact strategy. Automate a monthly investment into index funds. No special account needed. The critical part: automation. You don't set it and sometimes do it. You set it and always do it. Especially when the market crashes. That's when your discipline pays the biggest dividends. Here's the historical truth. Someone who invested $1,000 every single month into the S&P 500 for the last 20 years, including through 2008, through the COVID crash, through 2022, would have turned about $240,000 in contributions into roughly $1.2 million today. That's not because they got lucky. That's because they were consistent during the downturns when everyone else was panicking. Closing. Dollar cost averaging isn't revolutionary because it's complicated. It's revolutionary because it's simple and it works. Stop waiting for the perfect time. Start investing today with the same amount every month. Let the markets do their thing. Let time do the heavy lifting. If this changes how you think about investing, you know what to do. Subscribe, hit the bell, and start that first automatic investment today. Your future self will thank you.